Well, so what the tax torpedo is it's really what's happening with your retirement accounts. And that's one of those little secrets that nobody bothers telling you until it's too late. There are things that you can do ahead of time if you're planning ahead of time, but not when you're 70 or 73. Welcome to Wealth Creator Radio, where we help people overcome the uncertainty of having enough retirement income. I'm your host, Eric Heckman, a certified financial planner with over 30 years of experience. We want you to enjoy life and not have to wonder where your money will come from and how long it'll last. My mission is to show you how to develop a personalized income plan so you can retire more and have worry less wealth. Here at Wealth Creator Radio, we cut through the noise and get straight to what matters. We understand that the world of retirement planning can be filled with confusing products, ever-changing tax laws, and volatile markets. That's why we're here to help successful people like you navigate the uncertainty and create a blueprint for a thriving, work-optional life.
He's making a list and checking it twice. He's going to find out if you are naughty or nice. As we start off our show today, Eric is going to step into the booths as our retirement Santa to decide what's naughty or nice when it comes to planning for retirement. Let's start off with the phone number for our show, 800-454-1184. You may call or text the word visit to get a hold of Eric. He's president of Heckman Financial and our awesome team at Heckman Financial. Eric is a certified financial planner, and he's here to guide you about retirement planning. It's his goal to help 1,001 people retire by 2031. Remember, you can always text the word toolbox as well to this number to get Eric's book, The Blueprint to Worry Less Wealth, plus other educational materials. Text the word toolbox to 454-1184. And with that, Eric, happy holidays to you.
Yes, and you too. And this should be a little bit fun today, going through the list of who's doing only financial stuff.
Right, we're only going to do financial. We're
not going beyond that.
We're not going to get into personal matters. No, we are not. Okay, so when we were growing up, we all wanted to be on Santa's nice list, right? Santa always had his big book, and he'd decide every year whether you were naughty or nice. So anyway, that's what we're going to do today. So Eric, you're stepping into the boots. All right, so let's take this first scenario and find out if this falls under naughty or nice. Sam is 60 years old. He's thinking about retiring early, but he's only managed to save a small amount for retirement. His wife, Allison, is concerned about not having enough income for their Social Security benefits, but Sam says, it's not going to be a problem. What do you think, retirement Santa Eric? Would Sam's decision fall under naughty or nice?
Yeah, that could be pretty naughty just because of, you need to have an income plan. And, one of the big things that can be really scary with Social Security is in 2035, they're saying that they're going to be able to spend, pay about 80% of their bills. So what happens to that other 20%? We don't know yet. And so, I would not be retiring only on Social Security. That's a very scary situation to be in. And especially trying to retire earlier because of, depending on who's got the higher earnings history, the smaller the, 2 checks goes away when somebody passes away. So you want that, whoever has the bigger check to be the biggest ideally. So you definitely want to watch out for that and have an income plan and make sure you know what you're getting into. Make sure you can live on that and not get surprised because you don't want to retire at 62 only to have to go get a job at 70.
Exactly. Okay, very good. Thank you. All right, here's another scenario for you to decide about whether this person or these people are naughty or nice. Bob and Alice both recently retired. They're thinking about leaving their busy lives in L.A., and moving to North Carolina. They think that move is going to offer them a chance to enjoy a lower cost of living and provide them with a nice community of fellow retirees. So, Eric, retirement Santa, do you think this couple has been naughty or nice when it comes to their move after retirement?
Yeah, no, that can often be, pretty nice because of, that downsizing. Anybody pretty much leaving the Bay Area, especially, I've got lots of clients do that. Probably at least almost one every quarter, if not sometimes more.
Oh, wow.
And, the nice thing is they stay with me as advisors, but so that part's good. But I've got clients in, Pennsylvania, Florida, Idaho, just tons of different states that have, gone to different places, sometimes for the grandkids, sometimes, just because they want to be out there. But, they can sell their house here, pay cash for a place out there, and have extra money left over. So, yeah, it can definitely be a really great way to go. Again, the big thing there is, having a plan, though, making sure you know what's going on, making sure you know where that income is going to come from, making sure those dollars now are invested in stuff that puts off income, not just growth, because it's very different when you're retired. You have to invest very differently. And then you have to make sure you mitigate all those tax minefields that are going to be constant in retirement. I mean, taxes are the number one expense in retirement. And then, of course, healthcare and legacy. So that's the 5 areas of the blueprint to worry less wealth. And that's, something that we can help you with. If you want to reach out, there is some great year-end tax moves that you could be doing right now. Time's running out. It's getting very light in the year, right? So, if you do want to do that, you want to set up a 15 to 30-minute phone call with me, Eric Heckman, all you got to do is text the word VISIT to 800-454-1184. Again, text the word VISIT, 800-454-1184, or book directly online at wealthcreatorradio.com.
Thank you so much for joining us today. This is Wealth Creator Radio with Eric Heckman. Another retirement scenario to determine if this person is naughty or nice is this one. Ethan is a 50-year-old getting ready to retire. He started to notice that the cost of his everyday expenses, groceries, all the utility bills, even his favorite coffee, it's all inching upwards. But he doesn't worry about his retirement savings keeping up with these rising costs. He continues to spend his money as he pleases, Eric. What do you think? Is he being naughty or nice when it comes to inflation?
No, definitely naughty. That's one of the big issues. I've got one client, Beth, who, she's been with me for quite some time. And I think she said it was about 7 years into her retirement when she realized her costs had almost doubled.
Oh, wow.
And that usually should take a lot. Yeah, usually should take more like 20 or 30 for costs to double. But it depends on what you're spending money on, obviously, right? And what you're buying and things like that. But yeah, she really had to change that. And I was talking with another client recently, Carol, who looks like she's going to be retired now. She unfortunately got laid off and was planning on working, but hasn't worked so far yet because she hasn't gotten a new job. So sometimes it's tough to know if you're retired or working, right? Yes. when you don't have that job. So,
right.
And for her, when we looked at, okay, what were your plans, several years ago, it went from, it was about about 15% more that she's spending now than she was just about 5 years ago when we last had kind of done a lot of the plans for the income stuff. So, so you definitely always want to be looking at that, and it's going to go up throughout inflation, throughout your retirement. So yeah, definitely have that money increasing, not stagnant.
Exactly. And here's one more retirement scenario for you to consider, Santa Eric. Julie and Mario have been working hard all their lives, diligently saving for their retirement. But now they have a decision to make because their daughter Emma is ready to head off to college and tuition fees are so steep. They're torn between dipping into their retirement savings to fund her education or letting her take out student loans. Ultimately, they want to put themselves first and let Emma take control of her education. Retirement Santa, does their decision to not use their retirement savings for Emma fall into the naughty or the nice list?
Well, Emma may not feel this way, but it is nice. There's financial aid for college, but there's no financial aid for retirement. So it's all on you, right? And I see a lot of people do this where they're trying to help their kids so much that they, kind of shoot themselves in the foot and not able to, retire when they want to retire because they did that. So, think back to your situation. Did you have to do school loans or, debt and other things? So, it's fine to have people struggle when they're young. It kind of gives you some character, right?
Yes.
So definitely it's a lot safer to make sure you have your retirement plan set up and make sure you're on track. If you can help your kids, that's great. But, if not, then don't do that. Don't jeopardize your future, when they've got a long time ahead of them. And so again, this all comes back to planning. You want to have that blueprint to worry less wealth. You want to know, if you have that income plan, you could say, oh, can I actually take some money out to help my kids or not? And you'll know these things. Also it depends on how you're invested, tax issues along the way, healthcare and legacy. So these are all the areas of the blueprint to worry less wealth. And if you want to set a time to talk really quick and get some of your questions answered before the year end, just give us a call or text the word visit to 800-454-1184. Again, text the word visit 800-454-1184 or book directly online at wealthcreatorradio.com. Happy holidays and Happy New Year from all of us at Heckman Financial. We hope you enjoy the season and look forward to talking with you next year.
Hey, thanks so much for joining us today. I'm Lou Ann Fulmer here with Eric Heckman, founder of Heckman Financial, right here in the Silicon Valley area, helping people like you have their retirements and helping them achieve those goals that you have for retirement. So according to the Social Security Administration, a retirement benefit of $1,000 is reduced by 25% to $750 if you take your benefit 48 months ahead of your 67th birthday, okay? Or that would be your full retirement age. That's what that's considered. Now, if you wait even longer until you're 70, then that benefit continues to increase up to 8% to your benefits every year you decide to delay after your full retirement age. So many of us, Eric, are mismanaging this benefit. For some of us, when to start taking your Social Security is, like I said earlier, it could be $1 million decision or mistake. So I know you deal with this all the time.
Yeah, no, certainly. I mean, the average benefit right now is, sadly, only $1,900 per month. And so if you do the math over 30 years, that's about $600K. If you're married, that could be more than doubled. So that's over $1 million. But you do have to do the math right. And so it's not as simple as just delay.
Okay. Yeah, that's true. I mean, some people think that is, but so it is a big deal to make sure that you're taking Social Security at the right time. I think a lot of us think, well, I'll just call the Social Security Administration and that's where I'll start. But can those workers make recommendations, Eric?
They certainly give you advice and do stuff. So I don't know what their rules are per se, but I once had a client wait an extra year to get more benefit. And then when he called up, Social Security said, hey, we can give you all this extra money. And this was several years ago when they used to be able to go back even farther to get more income. But they gave him this big check. Well, what they did is they basically went back to where he had waited from and lowered his benefit, but gave him a lump sum. Well, if somebody from the government's going to say, hey, I can give you a whole bunch of money, most people say, yeah, hey, that sounds cool.
Heck yeah.
But he didn't realize it also lowered his benefit for the rest of his life. So yeah, I mean, it wasn't a client of mine. It was somebody I just met at a seminar, but that's what I told him. I was like, oh, well, that's how they did that.
Yeah.
And so again, you got to watch out what they're offering and make sure you understand what the trade-offs are.
Right. Now, okay, so let's talk about factors that we need to really be thinking about before we start taking Social Security. I've had, friends and acquaintances just once they turned 62 because it was available, they took it, So, yeah.
No, I mean, that can be really hazardous. So the biggest thing is, when are you going to stop working? And when are you going to really stop working is the second question, which sounds like the first question. But lots of times I have people who've stopped working and then they all of a sudden get a job offer, or they got some, their old company calls them back up or something. And, if you're before full retirement age, which for most people now is 67, and you keep working, usually you can only make around, in the low 20s in terms of how much money you can make. Super hazardous to turn it on and work. So it's a little different if you stopped working and you stopped working. Once you're 67 and up, you can make as much money as you want from work, and it doesn't matter. But so that'd be one thing to be looking at. And then the other ones, are you comparing the right numbers? Lots of times people say, well, 67 versus 70, if you wait those 3 more years, you get, so much more money. That is accurate. But when did you retire? If you retired at 65 and you're debating to wait until 67 or 70 to start your Social Security, well, what are you living on?
Yeah.
You're living on your savings, right? You're spending down money, and that money won't ever come back. And so what I've found for most people, I'd say at least 2/3 of the time when we run it under an income plan, it actually makes more sense if they've stopped working to start it sooner. at least for the person who had the lower earnings. For the higher earnings person, if it's a couple, then it gets a little bit more complicated, because then you want to make sure that higher earning person waits the longest possible, because once somebody dies, that higher check stays there. That's the one that you keep. So if you have a check that's $2,000 a month and another one's $3,000, one of you pass away, the $3,000 stays, the $2,000 goes away. Mm-hmm. And so you really want to make sure that check's bigger, but also you want to compare your own assets, because it's not just Social Security versus Social Security. It's what other dollars did you spend? And if you didn't get, say, $3,000 a month, $36,000 a year, it's $108,000 over 3 years. Well, if you didn't get that $100,000, where'd it come out of? Came out of your assets, right?
Right.
And you can leave your assets behind, but you can't leave your Social Security, behind to your kids and such,
yeah.
Right? So that's one of those things where it all comes down to planning. It all comes down to, do you have an income plan? Is it written? Do you know when you're going to start Social Security? What's the trade-offs? Have you actually done the analysis to prove which way is better or worse for your, specific situation? Are your funds now, your investments, starting to be aligned to where they're going to put off income? What's the taxes that you're going to pay? How's the taxation on Social Security can get affected by your IRA withdrawals? All these things, healthcare issues, legacy issues, and those are the 5 areas that we have to always account for in an income plan. So again, if you want to set up a time to talk with me, Eric Heckman, or if you just want a copy of my book or a lot of digital downloads, like Will Your Money Last as Long as You Do? All you got to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or download directly at wealthcreatorradio.com.
And again, you're listening to Eric Heckman. This is Wealth Creator Radio. Eric, let's get into some common mistakes that you have seen people make when it comes to taking Social Security. I bet you've seen it all in the last 30 years. You kind of mentioned, that one poor guy, what he did, but anything else?
Well, lots of times, he wasn't even a client at the time, but my own father-in-law years and years ago, he had, retired with a pension. And then all of a sudden his old company said, hey, can you come back and work on this one project? He retired early and he was under his full retirement age. And so when he did his taxes, all of a sudden he paid back every single dollar Social Security got, but he locked in the penalty for starting earlier because he didn't know about that work rule.
Right.
And had he known about that, he's like, that cut half my pay. I wouldn't, would have either had to have 50% more pay or, or it wouldn't have worked.
Oh, no.
But he didn't ask me. He should have.
Yes, he should have.
But so that's a big one.
Yeah.
I also find lots of times people do it the opposite, where they have the higher income earner person start sooner because that check's bigger. Again, if you're married and the bigger of the 2 checks is the one that lasts the longest, you want that big check to be the biggest. So It usually makes more sense to have the smaller of the 2 checks start sooner. So that's another one I see a lot of.
Okay, very good. And so you mentioned, the 5 things that you guys talk about in a retirement plan. Talk about how Social Security fits into that overall retirement income.
Yeah, well, obviously it's a big part. Sadly, it's a huge part for some people. Had somebody come to one of our movie events and she said how she hadn't saved anything and she was turning 60 the next month.
Oh, no.
She once had a few $100s in a Roth IRA and then had to cash it in. That's it. And it's like, what? How do you get that all and never saved a dime?
Yeah.
So some people it's everything, but for most people, it should be a good base of income. One of the concerns is that there is risk of it, having issues. If you look at their site, it always tells you when they're going to run out of money and until that gets fixed. So, it's not the only thing to definitely depend on. You need to have your own backup. You need to have your own guaranteed income. And so it's part of that income plan. It's definitely a good part. It's good money. But, where else are you going to get income from? Because you're not going to be able to survive just on that. And how are you going to get that money, building up? How are you going to get it pay out? How are you going to pay the least taxes over that timeline? And, and these are all the things that we talk about when we meet with somebody, again. So if you just want to ask some questions, you want to just say, hey, I've got this concern or I've got this concern, I'm really trying to help everybody that we can. So, we'll definitely do a 15 to 30 minute phone call. So if you want to get that 15 to 30 minute phone call, all you have to do is text the word visit to 800-454-1184. Again, text the word visit, 800-454-1184 or book directly online at wealthcreatorradio.com.
If something's worth doing, it's worth doing right. There's a particular time of life this phrase couldn't be more appropriate. How can you know you'll live the retirement you've always imagined? After all, life can be so unpredictable. You've worked hard and saved. Watch your accounts go up and down with the market. Your advisor says, don't worry, you'll be fine. But you still don't feel confident. Eric Heckman at Heckman Financial has a checklist to help you find out if you're on the right track for retirement. If you can check all the boxes with confidence, you may be ready for retirement. If not, Eric can help you address any potential costly mistakes. To get Eric Heckman at Heckman Financial's complimentary checklist, call or text LIST to 800-454-1184. Call or text LIST to 800-454-1184. Firm offers insurance services. Investment advisory services offered through Heckman Financial and Insurance Services, Inc. Investing involves risk, including the potential loss of principal.
Hi, we are so glad to have you with us today. I'm Lou Ann Fulmer here with Eric Heckman. He is a well-known speaker and author, and he can provide you with guidance to get you to and through a worry-less wealth retirement. Wouldn't it be nice to worry less? So the penalty for failing to withdraw those full required minimum distributions, or RMDs as they're called, or maybe missing a deadline, the penalty is set for 25% of the unwithdrawn amount. So, you don't want these steep penalties and maybe even higher taxes swiping away at your retirement savings, leaving you with just a fraction of that money that you were counting on for retirement, right?
No, certainly. Yeah. The required minimum distribution, or RMD, it can be kind of confusing, and they've also changed the law like several times. And so it was 70 and a half, it was 72. Now it's 73 if you're born before 1960, and 75 if after age 75. So it got really complicated. But yeah, if your RMD was $10,000, and the old law was 50% penalty, so they did reduce it. But again, if you were supposed to take out 10,000, that penalty is $2,500 plus the taxes that you owe. So you do not want to mess this up.
No, you do not. No. So, obviously, pre-retirees need to know some things about taking these RMDs from their retirement accounts. What do you want them to know, Eric?
Well, so just think of it as, the government gave you a loan. And what would be a question that you'd want to know about if you borrowed some money?
How much is it going to cost me to pay it back, like interest and stuff?
Yeah, exactly. Right. Yeah. How much and when, and also what's the timeline, right?
Yeah. Timeline.
So think of your 401k, your IRA as a loan to the government. They said, hey, we're not going to tax you. So that's cool, isn't it? Yeah, that's great.
Yeah.
So you take this money, you go off and invest it. We hope you do really well. I mean, we really do hope you do well, because the better you do, the better we're going to do. And so, but at some point they want their money back. And that, like I said, that point used to be 70 and a half, 72. Now it's, for most people, it's going to be 75 or 73 if they're, before 1960.
That'd be me. Yeah.
So that means you have to start taking money out and pay the tax, even if you don't need the money. Now, sometimes people will need the money, so it won't matter. But yeah, you're going to have to start paying that tax because they want their money back.
Mm-hmm. Okay. So yeah, I obviously need to get some guidance on that, or otherwise, like I mentioned, there's penalties for not taking those required minimum distributions. Talk about the impact that those costly penalties have on someone's retirement.
Well, I mean, hopefully you don't really actually end up paying them. You can, basically there's a special form and there's a little process that you do where you can ask to be forgiven. And as long as you don't mess it up every single year, usually the IRS is fine with as long as they know why and you do the paperwork. So yeah, usually you don't have to pay those 25% penalties, but yeah, if you just totally ignore it or don't do anything or just keep going year by year, yeah, it can be pretty ugly. And, obviously 25%, I'm sorry, I don't care how great your investments are doing. If you're paying a 25% penalty plus the taxes on the money, there's no way your money's growing. So, that's why you want to have good advice. So this is also really is huge on inherited IRAs. And this is really a bigger part for pre-retirees. There's a lot of people in their 50s and 60s now who haven't quite retired, but they're inheriting from their parents, and lots of times they're still IRAs and such. And And there's some really crazy rules around those. So, so those are even a special set of RMDs. So again, you want to talk to somebody who can really help you out. I actually do a lot of work with the Ed Slot team, with one of the master tax advisors with them, licensed to do tax returns. So, one of the things I think is crazy about my industry is a lot of people don't know taxes. They say, go talk to somebody else, and, to go talk to your tax advisor. And the tax advisor says, go talk to your financial advisor, and nobody's talking to you.
Yeah.
So one of the things that we've done is not only do I have my book, Worry Less Wealth, but we actually even have some free reports that are really quick reads. 10 to 15 pages. One of them is, are you paying too much in taxes in retirement? Will your money last as long as you do? So these are some great reads that you can get some good education, and really that's where it starts, right? Being informed, making sure you know what's happening to your financial plan. You could also set up a time to meet with me, Eric Heckman, totally no cost, complimentary. All you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox 800-454-1184, or download directly at wealthcreatorradio.com.
And you're listening to Wealth Creator Radio with Eric Heckman of Heckman Financial. And I love that you are really a one-stop shop. I mean, people come to you and you can get everything taken care of pretty much. Tax strategies. You're even licensed in Medicare and also Matt in your office. So that's the nice thing, that you are a full-service independent firm, aren't you, Eric?
Yep, exactly.
Yeah.
Yep.
All right, we're talking about just how to maximize your retirement income and how to make the most out of your retirement by taking certain steps. Some people who delay Social Security until 70, and then they have to start taking money from their retirement savings at 73, could be pushed into a higher tax bracket. Some analysts are calling it the tax torpedo, Eric. So I don't know if you haven't explained it already. Is there a way we can dodge that?
Well, so what the tax torpedo is it's really what's happening with your retirement accounts. And that's one of those little secrets that nobody bothers telling you until it's too late. I had a client who was, back when the rules were 70 and a half, not 73, but he came to me when he was 70 and he was retiring. 100% of his money was all in 401k and IRA assets. He had everything tax deferred, which means he owes taxes on all of it, right? So there's very little to no tax planning we could do because he had to start taking the money out right away.
Yeah.
And he also needed to live on. But so the first year they took some money out and, he had to pay a tiny bit of tax on his Social Security, but it was not much at all. So he was, I think, him and his wife had both waited till 70 to turn it on. So they had a lot of Social Security income.
Oh, well,
so that's part, it was great because I think their combined checks were about $60,000.
Oh, wow.
And so, that first year he was in a low bracket. But guess what happened at tax time? He needed to withdraw more money to pay the taxes.
Oh.
And so then he took out more money. Well, then happened the next year, that extra money that he took out caused more of his Social Security to get taxed. So he had to take out even more money.
Oh, gosh.
And then that next year, he had 85% of his Social Security being taxed. Why? Because he was taking money out of his IRA and 401k.
Oh.
And the first year, almost none of it got taxed. And so that was, almost 10,000 Social Security taxable income going up to about 50.
Oh, dear.
And so, big effect on your tax return. So that's one of those things where you got to watch out. There are things that you can do ahead of time if you're planning ahead of time, but not when you're 70 or 73.
Yeah, exactly.
So, this is stuff that you need to be doing in your 50s and 60s to avoid that. And there are solutions.
Okay. There are solutions. Get guidance. That's what we're saying. Don't go it alone because there are so many ins and outs that I think just us normal people, folks don't understand. But you, Eric, you and your team, this is what you do professionally. So obviously taxes are going to impact our retirement over time. Tell us what you think most people overlook when it comes to taxes in retirement.
Well, the biggest thing that they overlook is the fact that they're the biggest thing.
Okay.
That you can make more money, you can do some, make a little bit more interest, whatever, but taxes, hands down, will be the biggest factor on your entire retirement. And the more money you have exposed to Uncle Sam, the worse your retirement is going to end up being because you're going to have to pay more in tax, right? So if we can move some more of that money out of taxation, doing Roth conversions, doing some tax-free accounts, doing some specially designed things, that's just going to be more money in your pocket. So again, if you want to set up a time talk, or if you want to get, are you paying too much in taxes and retirement, some of those downloads, or even a copy of my book, Worry Less Wealth, all you got to do is text the word toolbox to 800-454-1184. Again, text word toolbox, 800-454-1184, or download directly at wealthcreatorradio.com. Happy holidays and Happy New Year from all of us at Heckman Financial. We hope you enjoy the season and look forward to talking with you next year.
Hello, I'm Lou Ann Fulmer here with Eric Heckman, president of Heckman Financial, where their mission is to get you to and through a worry-less wealth retirement. They put strategies together for you and help you plan out retirement. That is their goal, to help you have that remarkable retirement. So, all right, we're going to get into our mailbag questions right now, Eric. I know you get questions all the time. So you ready to do this again?
Yep, let's go for it.
Okay, so first question is from Jancy. And she says, I'm 61 and I just lost my job. What do I need to do to figure out if I can stay retired or if I need to start looking for another job?
Well, this one's pretty easy. Get an income plan. It's always the answer, right?
Yep.
So, no, what you need to know is you need to know how much you spend on a monthly basis on average. So I like to do that no BS budget where you add up all your expenses, all your withdrawals from your checking account for the last 12 months and divide by 12. And that's literally what you spent. If you're paying off your credit card, that's included in there. So once you know that monthly spending, then you can start going, okay, well, how much have I saved up, right? Especially for her at 61, she can't get Social Security yet. So she's going to be, using her savings. And, does she have enough saved up to put that income off and have it grow with inflation and make it sure it lasts all the way out to age 100? And, if the answer is yes, then, hey, you're now retired, not unemployed, right? Hey. But if the answer is you run out of money at 75, okay, well, start applying for some places. Right? So.
That's right. Okay, very good. Okay, next question is from Jolene. And this should also be from my husband, Eric, actually. I've started getting a ton of mail about Medicare, so I guess someone knows I'm about ready to turn 65. Should I keep all this mail, and then how do I decide on the right Medicare policy?
Well, hopefully you're not a hoarder, so don't keep all the mail.
Yeah.
But no, you do want to definitely look at getting that correct Medicare policy. A couple things, right? Are you still working? Because if you're still working, you don't need to have it yet, but you can turn on Part A, but Part B you don't need to do until you've lost your group insurance, and then you want to flip over. But yeah, if you need the insurance now, definitely get that on there. It's a lot cheaper than individual coverage for sure. And, you do want to have some advice. And so that's one thing that, Matt here in my office is one of our specialists in Medicare. And so we can, look at the prescription plan, look at the healthcare plan, because it's a lot different than what it was when you had group insurance. Your whole family doesn't have to be on the same plan. This one, it's very much more customized. So yeah, you definitely want to look at it and get some analysis done because, it's a lot of work. And, one of the things that we have set up in our digital toolbox is the ABCs of Medicare. We've also got, Social Security timing decision, and then will my money last as long as I do? Or am I paying too much money in retirement? All these great resources are quick reads. They're only like 10, 15 pages with not much jargon or anything, real easy to read. We also have a copy of my book, Worry Less Wealth, and even a spot to set a time to talk with me, Eric Heckman. So if you want access to that, super easy. All you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or download directly at wealthcreatorradio.com.
And thank you so much for spending part of your day with us today. I'm Lou Ann Fulmer here with Eric Heckman, president at Heckman Financial. We're digging into our mailbag today. Here's another question for you from Stuart. And he says, my father has Alzheimer's and it's really been hard on all of us. I'm also thinking a lot about my future and, what if I end up in his footsteps? What do I need to do now so my affairs are in order in case I start to lose my own mental capacity? And then who should I talk to for help?
Yeah, no, it's definitely a tough one and something that all of us should really be planning for just in case, but none of us want to, right? So, So, I mean, one of the biggest things is, yeah, especially if you have real estate, you usually want to have a living trust. And every attorney I know of, anytime they're doing that, they also set up a durable power of attorney for healthcare. And I mean, for financial management on top of the one for healthcare, I should say. And so there's two things, and you don't have to have a trust. You could just do this durable power on its own. So, one, the healthcare one's for, do I pull the plug and, donate my organs, all that fun junk. But the one for financial management is really critical. And this is just basically says that if you're incapacitated, which usually means two doctors have to certify you that way, then somebody else will now be able to take money out of your individual retirement account. They'll be able to take money out of your bank accounts, pay your bills, make sure your house doesn't go in foreclosure or, any of those types of things, right? And so, so it's really critical to have that. And, also really critical just to really have that discussion with people, in your family, like who's going to do it. I deal with a lot of women who are single that, they didn't have kids and stuff. So it's, okay, is it a friend? Is it going to be, who's that going to be? And it takes a lot of work too, especially if somebody's, Alzheimer's, something like that. It's even more emotionally draining, right? Versus just the financial part of things. So, that's the other part you have to watch out for, because is that person able to handle it? I had a client that had a older brother who was bipolar, and when her parents passed away, they named her the person in charge of him. And it was just, she had her own life and she was trying to lead, and this was kind of taking over her life. So she finally had to hire a professional fiduciary who just did all that stuff, because it was just, it was too much for her to handle. So sometimes it might be somebody else like that you need to handle, that you need to hire and such. So, it is definitely a tough situation. It's something where, everybody needs to have that plan. You also want to make sure you have some plans for long-term care, right? And how are you going to pay for that coverage, and how are you going to pay for all that care? Because right now that's usually $10,000 to $12,000 a month for most of my clients. So that's a lot of money. It's a lot of money that drains out really fast. So, the long-term care insurance is pretty tough because it always has, increasing premiums. So that's why, there's a lot of great alternatives that we have access to. So often that's what we're using for clients, the ones where they can just pay once and be done, or pay for like 5 years and be done. So, there are a lot of different ways to pay for that, that care too. So definitely something to be looking at and taking care of, because it's going to be something that could potentially happen to any of us, right? So
I know. So true. So true. One thing I want to throw in here is our diet too can really have a difference, make a difference in your outcome with Alzheimer's if you happen to have, it in your family or whatever, because the National Library of Medicine is calling it possibly a type 3 diabetes, meaning, that sugar is not good for our brain. So maybe watch your intake of sugar. So I just want to throw that in there. It can be, maybe helped so you don't get it if you're eating a healthy diet, so. Anyway, that's just me. But, I know that a lot of people are worried like this guy, like Stuart here, so I think that's great. And then just making sure you have everything set up in a plan, like you just said, Eric. So, okay, next question is from Debbie. And she says, I appreciate all the work that my husband has done to put together a financial plan, but he also keeps getting excited about different investments, and it's starting to stress me out that he's always changing our plans and chasing the next big thing. I just want to have confidence in our plan. I'm not excited about the investments he's talking about. What should I do, Eric?
Well, sounds like time to separate the finances and take care of some of it on your own, right? So, no, I do have this a lot. Actually, the funny thing for me is it seems like it's more often than not the lady of the couple that will, the wife that typically is the more aggressive one, which I don't know why that is. Historically, it always seemed like it was the opposite, but so there's often usually one spouse that's more aggressive, more, sometimes a little bit more crazy. I did have one client that literally he, did some crazy stuff twice and lost all their money, and then somehow kept building back up a bunch of money. So he's good at least working and finding the good companies to work for. But his wife's like, okay, we need to start diversifying. We need to have something protected. So, you want to have some money always in foundational or guaranteed assets. And so that's the biggest key, is having something that can't go away. So that way, if some of those other investments don't work out, then at least you get some money right? So again, but this all comes back to planning and knowing, having the right knowledge. So we've built up a lot of great tools in our digital toolbox. If you want to have access to that and set up a time to talk or download my book, Worry Less Wealth, all you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or download directly at wealthcreatorradio.com.
Imagine for a moment that an intense storm is pounding your house. Will the roof leak? Will the siding peel away? Will your basement flood? If your house is properly built and maintained, you'll be fine. But what about your 401k or your investments? The stock market has had a great run the last few years, but is its current turmoil making you feel uneasy? Are you confident your portfolio is built to weather the financial storm? Now may be a great time to have your retirement plan inspected. Call Eric Heckman of Heckman Financial at 800-454-1184 now. Eric will examine your portfolio and show you if your investments are in need of some weatherproofing. Call Eric Heckman of Heckman Financial today at 800-454-1184. That's 800-454-1184. Investment advisory services offered through Heckman Financial Insurance Services, Inc., a registered investment advisor.
Hi, I'm Luann Fulmer here with Eric Heckman. He is president of Heckman Financial right here in the Silicon Valley area, and you are listening to Wealth Creator Radio. So, Eric, on our show, we often discuss different challenges and risks that happen in retirement. Today, I think I'll have you give us an example of someone who's experienced one of those retirement obstacles. And we don't like to call it, but we call it a financial fail. So why don't you tell us about it?
I think one of the biggest problems when people invest is they know what they're investing. Well, often they actually don't know what they're invested in, but they at least know the price of what they invested in. And they know at some point they'll sell it when it's worth a bunch of money, but they kind of Pollyanna-ish or whatever you want to say, don't even think about the fact that it could go down. And when do you bail out? And when do you jump ship or whatever you want to call it? And I've had lots of examples over the last 30 years of this for sure. One more recent one was a guy who's actually a pool cleaner. He's making over six figures as a pool cleaner, which is pretty impressive, but he's nearing 70 and that's a tough job. It's a lot of work, right? So he wants to buy a house down in Pismo Beach, down the coast. And all he was waiting for was his Bitcoin to hit 300 and he was going to go do that. And his 150 became more like 75, I think, or something like that, if even that much. And so, of course, that changes the plans. I have another client that's looking to retire here and at the end of the year. And when I first met with him about 2 years ago, he bought a couple stocks. He actually bought several stocks, but there was probably about only two of them that were insanely great stocks. What happened was he when we first met, we were saying, hey, let's have some money, more guaranteed and safer. And then when the market dropped, at least the stuff that he had done with us didn't go down. His portfolio that originally was worth $250, when they met with me, it was $1.4 million.
Oh my goodness.
Then the two big high flying stocks dropped like rocks. And unfortunately, that $1.4 million dropped by $900,000 down to $500,000. So he should still be saying, hey, I've still had 100% gain. So, right, you can't complain about that. But when you had a 600% gain or whatever it was, it's a little tough to stomach the fact that you once had that all. And it was an easy fix. All you do is do a stop loss, which is the thing where, that automatically triggers if this stock goes down. But people say, oh, no, it's just down for a little bit. It's going to come right back up, blah, blah, blah. No, so they're still able to retire, luckily, but, it's going to be a little bit more watching the numbers. And they were thinking about keeping two houses that they have right now. And now they're going to definitely sell one because they just need the cash flow and stuff. So a little bit different change of lifestyle. And again, that's just because they didn't have a plan. So we've got a lot of great resources sitting up at our toolbox. Says, will your money last as long as you do? What's the right time to take Social Security, even my book, Worry Less Wealth, and a way to set up a time to talk with me for 15 to 30 minutes, no cost, no obligation. So if you want to have access to all that, all you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or download it directly at wealthcreatorradio.com. Thanks again for listening. We'll be back next week. Thank you for tuning in to Wealth Creator Radio. I'm Eric Heckman, and it's been a pleasure guiding you towards a more confident and secure retirement. Remember, my responsibility is to always do what's right for you, our client. Together, we can cut out that fancy-sounding financial jargon that doesn't help and focus on what truly matters for your financial future. If you're ready to take control of your retirement planning and build a personalized income plan, contact us at 800-454-1184 and text the word TOOLBOX to schedule a complimentary consultation. If you're looking for more resources and tools to build your retirement future, don't forget to check out the Wealth Creator Toolbox, your toolkit for a secure and confident retirement journey. Until next time, retire more and worry less with Wealth Creator Radio.
Information provided during Wealth Creator Radio is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Individuals should thoroughly review the contract for specific details of the product features and costs. Income payments and withdrawals from deferred annuities are generally taxable as ordinary income in the year they are taken. Eric Heckman offers investment advisory services through Heckman Financial and Insurance Services, Inc., a registered investment advisor. Any tax advice given as part of this presentation is not intended to be used and cannot be used by the taxpayer for the purpose of avoiding tax penalties or promoting, marketing, or recommending to another party any matter or transaction addressed herein. The views and opinions expressed in the program are not necessarily those of the radio station or its sponsors, and they should not construe as legal, tax, or investment advice. You should always consult the appropriate advisor before making any financial decision.
This radio show is a paid placement.